I do stocks. I don't do IT. All right, here we go. All right, I called this session the KISS technical trading because members pretty much know a lot of what we're going to discuss, but I'm going to try to be as thorough as I can for them as well, and anyone that has never uh, seen me do a presentation on this, you'll, I think, quickly understand it. So outside bars, when stocks are moving, this is the volume right here, and then this is the range of the day. I've got this on a daily chart right now. You could change that to 30-minute chart. You could change it to any time frame that you want. I'm going to use the daily just to start here. And each day creates a pattern, right? Each day has a candlestick of a high, of a low. If it's a green candle, it means that the opening was low and the closing was above that open. And how far above gives you the breadth of that candle. So sometimes if it opens like this candle right here, you can see it opened right there, dropped all the way down during the day, and then came all the way back up and actually closed above the open, forming a green candle. Conversely, here's a candle that opened up above the red, pushed up, and then came back down and went a little lower and then came back up and closed below the previous day, which creates a red candle. So when we're looking at these patterns in and of themselves, they don't tell you a whole lot. It's when they are combined with other candles and a higher time frame, as we call it, a longer period of time, that you start to see trend form. So obviously you might be confused through this area of where's the market going, and then it's pretty easy to see the trend of a market that's been going. So this isn't the market today. I actually started this intentionally after a long period of uptrend. This is all the way back to 2024, last April. Okay. And what happened last April is something that we're going to look at, that we're going to then look at this in sequence for the beginning of this year and then our current state, because that's what everyone's most interested in, is how did you know what was going to happen? And it's not so much me saying I can predict the market, I can time the market. It is taking the analysis of the market in total, okay, and coming in with a declaration of probability. So what we have happening here on this chart, I'm going to go forward just a little bit, and what you're going to see is this massive outside bar that was created here. Now, that was not the first outside bar that occurred. You'll see that there was one right here, okay? And I believe there was one other one, but I don't know if I have it marked. It's okay if we don't. But when you start seeing a sequence of outside bars and the market begins trading into a sideways pattern, the first thing that you think about is that there's some indecision that is going on in the market. There is a battle where sellers are outnumbering buyers or buyers are outnumbering sellers to such an extreme at different time frames within the day that you create an outside bar formation. Now, what's interesting and something I always want to know, if you know, I mean, when the day started, where was the market? Okay. We just talked about a red candle means that wherever the wick, there's no wick really on this, right? The wick, these are wicks. There's a wick. That's a wick right there. You see all of these little wicks, down wick right there. Okay. There was really no wick there. But what happened is the market opened from this position, the previous day close. It opened all the way back up here, even with this resistance level. And then anytime that you don't have continuation, and it falls down, then that is what is known as a trap, right? They trapped the buyers. So they opened it up. And I'm sure there was a lot of uneducated day traders that probably were buying thinking there's a big gap up and we're going to run, because this would have looked like a gap early on, because it would have opened from this close up here, creating a gap between the high and the opening high. And people like to buy a gap open. Well, if you had bought that gap open, you got maybe about 6 cents worth of upside before the markets just started selling, selling, selling all the way down through the previous day. And then once it got right here, you create an outside bar, but it didn't stop. It just kept going. Okay. So this would be what would be known in professional trader lingo as a mode 1 sell day. Okay. A mode 1 sell day. And that is that wherever it opened and starts selling, it sold through the entire day. There was no reclaim. It just kept on selling. You have mode 1 days to the upside, similar to this here, where it opens here and it just keeps trucking. Mode 1 days that happen. And they're not that frequent, right? They're not as frequent as any other trade. Most days you have either a chop or you have a trend day, and those are all marked by a number of things. We're not going to go into that right now, don't have time. But the moment that you have been on a long trend, so you have this long trend up in the market that you've been channeling, right? You've been following this channel that's going, and you could see it even got tighter here in the later half. The first half to the second half started getting tighter, kind of a channel within the channel here, right? Once this first outside bar appeared, okay, when you're going up and you have a trap on that day, okay, I start taking notice. It doesn't in and of itself mean anything. A single bar, outside bar, yes, it is fine for some short-term trading. And again, I'll cover a little bit on that, but I'm more interested in talking about how this is used for macro, and in particular to what is happening right now in the market, and to give you an edge on what's going to happen and not put yourself in harm's way. That's really the key, is how can I protect my money, my core disciplines and my positions? What should I be doing with them? Is it okay to be buying long, short? How do I manage the market? So long trend, first outside bar in itself, nothing, means not a whole lot in and of itself. Okay. It does denote that there was some battle going on that day. And that in this case, since it's a red candle, the sellers outnumbered the buyers. And so you ended up with an outside bar to the downside. This one here would be then, I think, the second one. I'm looking and I don't see a second one in between here. So this would have been the second one. And when I see that second one, especially if it's in line anywhere close to our resistance area that we've seen our topping happen, where we topped, pulled back, retested, and then pulled back again. And then you have this open that then completely fails. You should really start taking notice of that. Okay. It becomes more important. So then as we move forward, you could see what happens. And I'll go to the next sequence in January to March. We'll do this very quickly. I want to get to that one because it has some nuance to it. But what you'll see a lot of times is when you get these big outside bars, if they do not fail, or if they fail and then reclaim back within the inside bar, you usually end up pushing to at least the 50 fib level of that bar. Now, this looks like it closed. It expanded and flashed above the 50 fib of this, which is just basically the mean between high, low, the 50 fib. In our world, in OA1 trading, that's called Model T. And the reason that I call it Model T is pretty simple, because it's a sideways T that you have here, where that and then sideways right in the middle of it, it forms that T that you're watching. Okay, so it kind of helps look at that. So this happened where if you have the markets hold within this base after a sell down day and it won't fail, usually you're going to get a move to the 50 fib. Not always, but once it starts moving, you actually, in your mind, my instinct and now your instinct should be, I need to be trading into that 50 fib, because that would be what's called the meat money, the easier money. Okay. And do I need to be paying attention to the 20? Not the yellow here is a 9 EMA. The 20 is the red one. This is the 50 EMA, and this is the 200 EMA. Do I need to be paying attention to those in terms of reclaiming up through? Well, absolutely. So as you could see, the 20 EMA was kind of right in the middle of this move that occurred. So when it reclaimed, it almost was certain to make it to that 50 fib mean, which was also in line with the 9 EMA. So you kind of had two technical in your head, the 9 EMA and the 50 fib in your head that you were trading to for that day. This is how I would trade that day. Okay, that's how I did trade that day. But at any rate, there is a warning sign that's hanging over you because you've had this outside bar. You now had a large outside bar, and lo and behold, 3 days later, you get a third outside bar. They're not that common, right? Go look back through and you won't find a whole bunch of outside bars. One in a sequence, no big deal. When you start getting multiple outside bars, something is at work within the institutional market. That's what's important. And I have personally, and it doesn't work every single time, but it's well over 90% of the time, I have a 3 strikes and you're out philosophy. You show me 3 outside bars in a tight sideways action look to it with topping right here where this trap occurred, especially. You give me 3, and that's 3 strikes and you're out. I actually started this service on this day. And unfortunately, the first message that I gave to all the members was you need to sell everything that you have or put hedges into place. So that is the key. Okay. The message was maybe this was the third. I don't recall exactly. There may be another one. If there was, that would be the third strike, and that would have been the call that day versus this day. Get out of the market. Okay. Don't be long if you're doing anything by puts. Okay. But get out. If we move forward in time, what happened? Okay. We started then failing with lower highs down through this sequence here. I don't think that's an outside bar. It is not. Okay. The wick is above the high here. So that's not an outside bar. But what you're going to look at, and in general trading rules, by the way, on a single outside bar, when it breaches, I'll draw that down. When your closes below that outside bar right here, when it closes below that, that is a confirmation right here. It closed below it. That's a confirmation candle that you watch for. And regardless of what happens afterwards, until you clear this, I will not trade long. Okay. I won't trade longer term. I may take an intraday trade. I'm not saying I won't trade up based on price action and things like that, but I will not take a long position. I'm trading basically what I call the windshield. I'll walk into the day. I'll have my trading plan. I'll say, if this happens, then I will do that. If this happens, I will do this. And if neither happen, I won't trade because I got a plan. Every day I walk into the market. You should too. You have a trading plan based on the structure of what you're looking at. So this closed below this outside bar here. To me, that was a kind of the ending red light sequence of the move. You'll notice that it did trade to the 50 fib of that day. Okay. So it did make the 50 fib that day. The next day, it came up above the 50 fib of this day, almost to the top of that candle before failing all the way down. So it trapped basically. And that's another thing that you need to be aware. Institutions love to trap you. You are their fodder for accelerating a downward move once the jig is up. Once the breakdown's coming, they want to get as many people buying as possible in retail. So my goal is to beat institutions. That's been my existence, is to train enough people to recognize how institutions work and help you beat them at their own game and profit from that. So if you had puts from this setup, you did exceptionally well, but this was just the beginning. Now, there was a technical that was given right here. I'm not going to go into that, but there was, and we called a bottom, a short-term bottom there. It was just a bottom, and it turned out to be a very good tradable move all the way up into here. And so that's another lesson at another day. And then it came up and we hit an all-time high. We had an outside bar here just above that trapped, okay, but we had closed above all of this. So in my book, you are free to take long positions as long as the base of this structure held across here. And that's not a perfect line, but you understand what I'm saying. Whatever this base was, I want to see it held. Retested, absolutely fine. If it goes below that, as long as it reclaims by the end of the day, again, absolutely fine. But an outside bar, now this one did lead to a down move. It was a downside outside bar. It came back up to the 50 fib. It opened and trapped people up here. Actually, it came down and then back up and trapped a bunch of people and then opened down and came in. So generally, when I'm this close, I'm just going to trade the day. But I want to keep going through this cycle now. Okay, and now where are we at? We're in, you see this outside bar here. Okay, well, we had this outside bar here, right here. So in general, when I see an outside bar, here's the second one right here. There was the first one, and then it pushed up above and closed above it. And this is exactly the same technical. When it closes above right here, that outside bar, generally it means that you have an opportunity for upside. Not all the time, but sometimes it means even just the open the next day is going to be up. Even if it's a trap open, you could still make money on that. If you understand how the price action works and you watch overnight price action, you can make money off that. But there was a second bar here, outside bar here, okay? And so your alert system is going off again. And I don't see a third one yet until right here. I don't see a third outside bar in there. So, but it turned over, and the regular rules of outside bars would have said get out, okay, of here, the base of this. It closed below it. It dropped down, it came up, and it retested back into this. You see that? Retested back in, failed, came back up, and this became really pretty good resistance. Draw that once that happens all the way across, and then pay attention to where markets are touching and stopping at that level, and then when they break through. And what you'll find is it'll help you in terms of it'll break through it. You could see it retested. It went sideways, retested, and then it failed back down through, creating a period of down, 3-4 days of down movement. And then this liquidity grab, and then look right into it. Next day it broke above. So your thought process is again to the upside, and then you get going, and your stop levels would be in here, right? It creates for you a stop level. So it gives you the ability to regulate how you're going to trade. I'm not willing to hold a long position below this level now because of the technical that it's been showing me of testing it, failing. So if you buy, I'm not going to hold that buy if we fail and close below here. Okay. So in this instance, you wouldn't have gotten stopped out, and you got a nice ride on that move. Let's keep going forward. looking for an outside bar on trend. I'm doing this with you. That could be an outside bar, 608.44. Nope, not. I do not see an outside bar as a precursor to the drop in this instance. So this is, I'm giving you what outside bars can tell you, not that it happens every time. This does not look like, except this one here. This was a massive one, right? Here was the previous day. It opened right there, pushed up, and then trapped, and then just had a mode 1 sell day all the way down. Okay, complete failure of this support area through here, which you would have tagged, especially right here. Okay, resistance, resistance, breakthrough, break, and then break back down through. Just always go to your lefts. Zoom out, look back to the left, draw those lines so that you could see where they intersect and you form resistance areas that when they break, it means something. So you had, obviously, this was in a sequence of an uptrend that turned over. Whenever it turns over, you want to draw a line across and then come in the next day. You see this day, it stopped there. So you come into the next day saying, is today the day maybe we break and continue, have a continuation trend? Not really. It kind of trapped on that, got open down here, ended up right on it, but didn't break. Next day, same thing, and then it broke. So if you want to take a trade, take a trade. And then just make sure if you're intraday, if it comes below here, this close down here, get out. Okay. If you wait for the day's close then and it closes anywhere below this, get out. Okay. Just get out. Why risk it? So you got a few days move, but then you had this huge trap that occurred on an outside bar. Well, that looks like the only one to me. I don't know about you, but that's only one. It came down. I'm looking for another outside bar. Here's one right here. Okay. And it closed above that outside bar. So again, the next day you should have at least an opening move to the upside. That's laws of probability, right? It's not 100%. It's just that your lean going into the next day, closing above this, would be that I'm going to have an upside open of the day. Doesn't mean the day is going to end up there, but generally you're going to get an upside open. Well, it opened all the way up here. It gapped up. So if you were like, well, I'm just going to wait till tomorrow and see how this goes, you would have missed the gap up. And then you would have been in a frozen position saying, do I buy? Do I sell? This day would have just been a wash day for most traders. Okay. You would have been trapped probably all day long. It looks like it went back and forth and closed very tight. And then the next day failed back down into a new low here. Okay. So you came all the way back up. You've already marked, right? Knowing what you already know now, right? If you didn't know it, now you do. You had already marked this resistance. Obviously, this line would only go to here, to here. Each day, you would just be keeping this line. Usually what I do is use an alert. Just put an alert up there. That way, you can get rid of and just leave it there. And once that alert goes off, then it tells you, hey, let's pay attention and see if this is a trap or if it breaks out. Does it close above it or not? So this failed, it trapped, and it failed back down. It retested in, it broke up above and actually gave a false reading, although the next day, even though it opened down here kind of at the 50 fib of this day, it did go up on the next day. Okay. And that, however, I'm going to remove all that. That was a small outside bar right there. See it? I don't care how big it is. To me, that's number 2. Okay. That's a second outside bar. To me, that would be strike 2. And then it failed back below this line, right? You also would have had this line continue to stay there. I use an alert myself, right? Use alerts so you don't have to draw lines all day. So you would just have had an alert sitting here on top of that. Okay. And you could adjust it a little bit. You could say, I want to move that up just a little bit at the top of that close right here. Okay. So I'm just barely above that, but I see this resistance. I see how they've been hitting this level, and it became a pivot for the day, but it didn't hold, right? So those are all valuable things to know. And you can see all of this up and down across this, right? Just every day for a while, sideways movement. So this period of sideways action in the market, okay, some people call that a Darvis box, although I don't feel personally like this qualifies because of the dips below some key levels here. But generally, sideways action, if it's elongated, you could call it a Darvis box. But here is then strike three. Strike three. That right there is the third outside bar in a pattern that's been having difficulty with continuation. I get out. If I'm in the market, I'm out of the market. Okay. It came up and it hit an all-time high. We're now in this year. This was the last time I told everyone to sell, right? Well, next to last, you'll see in a second, right? So this was the last time I told everyone get out of the market. Okay. And I even posted that on Twitter. The market just had, in my view, a strike three, and that means go flat and buy puts. Okay, in our room, we may have bought some close puts, but also I'm mindful that I have people with small accounts. So what we did is I said, why don't you buy the 420 puts out 90 days? Let's just go out 90 days and buy the 420 puts. It's not like you're going to get 1,000% ROI on a put that far out, but you know what? When you're that far out, number one, they're super cheap. Okay, that far down. Number two, they don't move hard against you, especially if the market were to continue sideways for another week or whatever. You're not going to lose half the value of your put. And if you're doing a 0-day expiration, and I do a lot of them, but once confirmation is in, I do that. Well, that's great, but you're going to lose 100% if you're wrong, right? If you're not trading very actively, if you're just like, well, I'm just going to buy it and see what happens, that's a terrible strategy. So I tried to protect the mass when, all members. And so we went cheap. I have people with $20 million portfolios. They're free and they're smart enough. They'll come in there with a 550, a 560 put out 60 days, 90 days, because they're protecting a much larger portfolio. Okay. So I came in with the 575 personally, okay, out 60 days. So strike three. It went up. I had at least 3 people on Twitter saying, great job, dude. Markets just hit an all-time high off my 3 strikes. Okay. Great job, dude. Well, they got trapped. Okay. They got trapped. Markets came down, and then you had a fourth. I don't need these anymore. They told you something, though, didn't they? Let's get rid of this. They told you a support level that got broken, right? So you had this outside bar right here. Major trap that also happened to be, if I had left that this here, it also happened to be a retest back into this structure, right? Of all of this period of fighting going on, this was a retest back into the base of the structure that happened here. What that is for institutions, and put it in your notes when you see that, that's institutions catching these guys that were like, see, okay, yeah, it did come down, but it's going to go back up. That is the institutions trapping with a big push-up day just before, and then the opening up above giving the appearance potentially of this. Okay. What they did is then they trapped them and then had an all-day mode 1 sell day, creating an outside bar. Okay. Now, it did not close. Let me get rid of this. the low here was 584.65. The low close here was 583.77. So it closed below this level here. Okay. I need to get a close below this outside bar. Okay. It closed below this. That's great. All right. But in and of itself means nothing. I want the outside bar to have a close below it. Here it was. So once that happened, I was firmly convinced that the markets were tanking, that the markets were about to tank. Okay. And so that then led to another trap, retested back into this basing, retested, I'm sure gave lots of hope to people, and then trapped them. And let's just keep going forward. And of course, everyone knows what happened at the beginning of this year. Okay. We just dropped all the way down into this acceleration low. Okay. Don't know if that's an outside bar. 576.41 doesn't look like it. 576.33. No, it was not. So you had this capitulation. That's another lesson. I'm not going to go through that right now, but I called a bottom here. I said Sunday, this was a Sunday night, and I said, I am buying Meta, Netflix, Microsoft, putting money into the market. Okay. Again, spotting a lot of things, including overnight institutional activity of buying that was going on, which continued into the day. And then you had this capitulation shaking. In case there was some lucky buyers, they were shaking the heck out of this market, okay, trying to get rid of you before they were going to then do this, take it up where we are now, okay? So now, I'll get some questions here in a moment. Here we are today. We had an outside bar right there. In and of itself, doesn't mean a whole lot. Just something that I took note of, right? Told the members, hey, that was an outside bar, right? Need to be a little cautious. Obviously, it means something when you break below it, which we did here. Okay, we opened above it, came all the way up, and then came back down, and it failed below there. That presented a trading opportunity to the downside when that happens. You watch the 9 EMA then, because that would be the easy money, is between here and there. That doesn't look very long, but it is. It's about $4 worth of SPY move that occurred from losing this after the open down into the 9 EMA. Easy money. Take that easy money, and then let's move on and wait for the next trade, right? But you got the close below that outside bar, okay? So generally that means what? It means generally there's going to be some sort of continuation generally, okay? Didn't happen here, but the next day it did, okay? Down into the 20 EMA. Again, take your money and get out. You also are going to, I'm not going to talk about gaps. Obviously, those play a big role in your analysis. But it came back up then, and this started this sideways action period that we've been going through. We then had a second outside bar right here. Okay. So we've had two outside bars now. Again, Friday, what happened Friday? We have an outside bar. It was set with a open right up here. It failed all the way down to here, okay, below the previous day, and then came all the way back to the 50 fib of that day. Again, that 50 fib is your punch card to fortune. And again, I'm not going to do a session on the 50 fib, but it's the greatest thing that's ever been given to a professional trader. So it came all the way back up and closed around the 50 fib. The next day, it opened just at the 50 fib, pushed up, and then actually it opened way down here. So this was a trap. And then it opened Friday. We just went through this, right? We opened deep. So the warning shot would have at least kept you out, right? Because I told people that that's the second outside bar. When I get three of them, I tend to just go flat. Well, we've got two of them. So I start promoting caution. Why don't you just be caution, everyone? Bank your monies. Let's just hold our water here and see, since we're sideways here, then let's just wait and see. And if you look all the way back where we were drawing these support and resistance levels, check out where they're happening. Should anybody be surprised what's going on here? Look at that. Look at that. So we're battling right again through this zone right now. Are we going to go up? Are we going to go down? Well, I know one thing. This guy ain't going to put a ton of money into the market until this gets resolved one direction or another. Okay, right? So that's the key. Is now I have two outside bars. I have a down move. It reclaimed. Now, generally, whenever you get a reclaim move in the market, and when I say reclaim, it reclaimed back within and above this, right? So you had a Friday afternoon rally that we made money on. I made some pretty good money on this because once it came back above, it recaptured this. That's a failed breakdown right there off of an outside bar. A failed breakdown is generally you go ahead and just take your trades because you got an easy stop. I call that compression. And all I mean is that price action has compressed to where you're not that far away to get out of a stock at a new low. If I'm going to take a stock share position, I'm just going to get out if we trade below here. Okay. And if I'm in an option, I'll generally go out a few weeks because, again, the impact, if I'm wrong, is going to be from here to here. Okay. If I went with a long call, based on this reclaim, I, number one, got a trim, meaning I was able to get enough of a move to take some profit off the table that then makes this probably net neutral at my stop. Okay, worst case scenario. So it reclaim generally means that you're going to go, you tested the bottom end of this and you have this support resistance level right here that you've noted all the way back to here. You closed above that. You would have wished the market would have closed just above it because the reclaim is a failed breakdown, meaning you're likely to get a Model T 50 fib move. Well, they took most of that away by moving the market all the way back up. And I don't know, Manuel, is that 50 fib? It may have closed at the 50 fib. But it's close enough to where it's certainly you can't walk into Monday and say, you know what, if we closed here and the futures are green, I'm getting in and I'm going to then trade to the 50 fib. And I'm just going to either get out or at least trim heavily down. And then I'll wait and see how this resolves, right? So always about trading. What is my trading plan? What am I seeing that I'm going to trade? Keeping the macro in place, meaning that I've got sideways action going on right now. That means some uncertainty highlighted by the outside bars, meaning a battle is going on between bulls and bears, creating an outside bar. The bulls were like, I've got the bears trapped. I'm going to squeeze them all the way up through that previous day. The bears are like, oh yeah, well, watch this, right? So let's see, 530 was 583.24. No. I don't think that's right. What is your Model T from yesterday? I'm sorry, from Thursday. What is the Model T of this day? Is what we want. By the way, shout out to Manuel, who volunteers, and he provides us with, I'll show it to you. This is a list of all of the today's Model T, meaning after the close, what is Monday, the 50 fib that you would be looking for on all of these stocks based on trend, okay, where they'd be. These are all of the outside bars on individual stocks that occurred, okay? So that gives you some opportunity for potential trades, right? Hey, we just closed above an outside bar. That gives this stock an opportunity to go up, or we close below it. I need to be watching to see which way we end up. Are we going to close above or below that outside bar? And then we also mark inside bars, right? Here is an inside bar that occurred after an outside bar. Okay. Inside bars have their own trading, and I'm not going to get into that right now. But anyway, he provides this for us, much appreciated, because it gives a lot of great info, and it's your first stop that you go to at the end of each day when he posts it to start looking through stocks for trade ideas for the next day. Okay, should begin right there on that. So let me look at that list. It says 587.18. Okay, this day's. I'm sorry, I'm looking at the wrong day. Yeah, you posted at the end of the day. I need the previous day. Thursday, 529. Model T was what? Let's see. I can't see SPY. There it is. Man, I'm getting too old for that. Well, what does that say? That says 580. Is that a 9 or an 8? 588.64. It looks like to me. Correct me if I'm wrong. 588.64. Yeah. Oh, 589.64. Okay. So we closed the day. Make sure this is turned off. Yes. We closed the day at 589.39. So do you think you have a whole bunch of trade opportunity Monday for Model T? No, you don't. You would be looking at this day's 50 fib as kind of a regulator. And then what do? Well, you factor everything else in, right? The 9 EMA happens to be resting just below the 50 fib of this candle, right? Pretty close on it. Do you think that's something that I should be aware of as a professional trader come Monday? If I see us open here, pull back on volume, and then reclaim, that would be then, I would read that as a shake and bake type move. So if I saw that, I would tend to trade upside to that with a stop back at that level, right? So anyway, it gives a bunch, but I'm wanting to talk about these outside bars. We've only had 2 of them. So now you're on board with me. And if you like these technicals, then be watching for the next one. Okay, let's watch for the next one. In the meantime, what are we going to do? Well, we have this outside bar here, was the last one. We traded below it, but closed above it, negating this day as any type of an indicator other than a failed breakdown. Okay, we're going to be watching for where it closes. When? Maybe Monday, maybe Tuesday, maybe Wednesday. You need to be aware of that level though, above and below. I want to see where it closes, okay? And then that becomes very important to you. If you get a third outside bar, another trap, whichever direction it traps, I would be leaning to go with that direction, meaning that if the markets were to come down and have an outside bar to the downside, okay, and then the next day it came back within that bar and made it to the 50 fib, I would watch that extremely closely. Above the 50 fib, I would feel pretty good about it if that outside bar, right? The next day, I would be bullish on the market above the 50 fib of that outside bar day. So if we get above the 50 fib, I'm going to watch for the trap. Don't want to be institutional spotters. So what you do is you sit back, you wait for a higher time frame, whether that's 30 minutes or whether that's through the opening imbalance period. And what that means is the first 45 minutes of every trading day, all of the orders that came in at the end of the day or overnight to be executed to the institutions are cleared by the first 45 minutes of trading. That's why the volume on any particular day at the beginning of any particular day, okay, you generally get some pretty high volume that occurs. Okay, you come into this day and you get a volume surge that occurs there. Interestingly, this did not have one, by the way, on Friday. I went golfing at the first part of the day and missed all this. I didn't get back until here in order to be able to make some money to the upside. So I would have noted that, though, that guys, yes, we're starting down deep. I see the selling. I see this acceleration selling going on. But you know what? The only volume that you have on the day is when these two were accelerating in, creating a V bottom. Okay. That to me would be worth watching because there's been no volume. So it's not like everyone's panicking and getting out and they're fighting over getting out. There's nothing going on. It was a boring looking day until this broke, this support level broke down and it traded down. And then you watch for those acceleration candles. And then when that divergence hits and you get this liquidity grab, you see it right there, green, then you start watching not only this first move, but I always like to wait and look for this pullback. And again, 50 fib of that move from here to here. I watch for that 50 fib. It broke down through it. This is just a guess. It broke down through it. It did not hit a new low. And then it came back up. This is where you enter your trades because you're compressed with a stop below here. That's compression. That's how you win. You're not going to win every trade. You're going to have a losing trade. It's just that my trades lose very little. Whereas some people may have bought and they're like, oh boy, let me see. Maybe this will turn around. And then by the time it gets here, they sell because they're getting absolutely killed. And then the markets turn because institutions are great at psychological warfare. Okay. My members are just better. I want my members to be better than the institutions are at their little games, right? Because they turned this thing around and it ended up coming back above all of this early resistance level that started the whole thing, right? That led from the previous day resistance. So anyway, that's now I'm going way beyond what I meant to discuss. What questions do you guys have? I'm going to open up a Q&A here on the chat. I don't know if you can see the chat. Do you have questions that you would want to ask? I'll mention a couple of things while you're doing so. The volume matters a great deal on those outside bars. Okay. If the outside bar has net par value, okay, I might treat it as a trading opportunity, trading down below it. Okay. But it doesn't tell me anything about trend. Okay, longer term trend or anything. It doesn't make me say everyone needs to abandon ship and get out of the markets. It doesn't do that. Okay, and again, that's also based on trend. If I've been going up or if the markets have been going down, like here, and it gives me an outside bar, then I'm going to start thinking upside. Okay, on that. If I've been in a long downtrend, I'm looking for where that might terminate. So things like outside bars to turn it around become important. The battle creates the outside bars. Once you start getting outside bars, it means that in a downtrend, the bulls have started stepping into the table and they're at least showing interest in buying because you're not just dropping, you're getting an outside bar. Okay, they're meeting the sell orders with buy orders. And then you pay attention to any type of volume crescendo that comes in on top of that that helps you identify then potential basis. And then you have all the other indicators. I'm not here to talk about all my other indicators, just outside bar analysis. 3 strikes and you're out. Use the 3 strikes rule on outside bars when you're trading sideways, and you will avoid a major loss in your account. I can always find another trade. You can always find another trade. When you have a warning from yellow to orange to red, outside bar, outside bar, outside bar, get out. Just get out and wait for that level to resolve and then start your trades that way. Okay. Otherwise, if it's been a long uptrend, take the downside. Go ahead and buy the put side. That's what we did. Okay. We bought the puts. Those puts that we paid $1.16 for went over $8. So you don't have to spend a bunch to have protection that ends up making you a heck of an ROI. Am I right, guys? Right? You don't have to have a lot. So are there any questions that you guys have? I may have to start it this way, Q&A. I don't know if that changes it. Let's see. I've got it on the Telegram app. Do you mess with net free shares with outside bars or in general downtrend? Or do you completely ignore since it's net free? Okay, that's a great question. Okay, so let's look at PLTR. This is Manuel's favorite, right? Kramer saying pay PLTR is not worth the paper it's written on. Somewhere in this cycle, I think right here last year, is when Kramer made that statement. I went on Twitter and said, what a clown show this guy is. We were accumulating, right? I had given it to everyone that this is something that I am accumulating a large position in. Did due diligence, read the homework, did the effort to understand what it's all about. And it wasn't 3 days. You can go back on Twitter, look up PLTR, Old Army One, and you'll find it where Kramer made that statement that PLTR is not worth the paper it's written on. Now, he changed his tune, didn't he? I mean, he was like, I think PLTR has more. I don't care. If a guy's telling you something like that and he's so completely wrong, there's an issue, in my opinion, with his technical capabilities. So we were buying, and when this stock was somewhere in the $12 to $15 range when we were accumulating it. So I can't even go back far enough right now. It made the move when you buy at 13, let's say. What he's talking about net free is when the stock reached $26 right here, okay, or maybe back here, $24.40, $26 right here, okay. I don't think it did there. 25, 35. So $26, that's 100% gain from your $13 buys, right? What I'll do, and this just depends on if I only have 500 shares, well, I'm probably not going to do anything with it. I'll just hold it all. But if I have 10,000 shares, what I'm going to do is I'm going to sell 5,000 shares at $26. Or I'm going to do a covered call on half of those 2,500 shares of them and then buy puts against the 5,000, okay, the half, so that I have some upside room on the shares, but I have no downside. I'm going to limit my downside risk to allow me to hold those shares just to see if it breaks on out, right? I chose to just sell. All right. I wanted to move into some other things. I have so many net free stocks that's how I think you build wealth. Is I don't know who the big winners are going to be ultimately and who the big losers are going to be ultimately. I don't know the answer to that every time, right? I have instincts on it. I have experience on it, but I don't know. No one really would know that, okay? Other than maybe some institution that has a plan to just buy it up to a certain level. But once it hit 26, you sell 50% of that position. You get your money back, 100% of your money back. And then what are you going to do? Are you just going to let it go? Okay, well, personally, no, I don't. I move it to another portfolio. And if it's in sequence with a macro triple outside move that's telling me to get out of the market, I'm not going to get out of the market. It's already net free. It's not going to cost me against my core value of my account. What I'm going to do though is I will take a protective put when I have that triple outside bar on all of my net free holdings, Microsoft, Netflix, Meta. I don't care what the stock is. I will come in and I'm going to buy a protective put. Now, I'm not going to spend a gazillion dollars, okay, but I'll take something in a range on that. So let's take PLTR right now, okay? I have two outside bars in the macro market. I'm just watching to see, are we going to break to the upside? Are we going to break to the downside? I don't know. I may have a bias, but biases can get you in trouble. Trade price action. Trade the technicals, okay? Don't let biases ruin your life, okay? You can have them, and my biases tend to be pretty good. If you ask the members, they're pretty good. But I really have a net neutral bias right now on which way we're going to go. I just have two outside bars. It raises a caution flag to me. Okay. I see people on Twitter saying, here's the mark is going to, we're going to go into a downtrend right now. We're done with this wave, that wave, or we're about to break out to all-time highs. You know what? I don't know that. I think that's crazy thinking. Now, someone's going to be right and they're going to crow about it. But I guarantee if you go back to their timeline, you'll see where they've been wrong, and probably a lot more than they've been right when they make those type of just grandiose predictions. That's not what we want to do in trading. Okay. We want to be measured in our approach. So here is PLTR. Well, obviously PLTR, number one things that stands out to you is that it's broken above this resistance. It closed above the resistance once, twice, failed back down below, but now that was a powerful, all the defense sector. We found this, the defense sector just took off Friday. Okay. Maybe it was on that comment by Jamie Dimon about we ought to be spending money on the defense sector. But you'll notice that you have an outside bar here on PLTR. And once you broke to the upside, you would want to take a trade up. And your stop level is pretty simple, right? You got an easy stop in your window based on this technical. It didn't stop. It just kept on going. It closed above not only all of this structure, but it closed above here, a new high close. That's an all-time high close, right? Well, now you've got blue sky opportunity if it gets above this 133.49. So that's something that everyone, I'm giving you some free trades here. If you get above 133.49, that can be a trap. Your stop would be back down where? Well, below here, where it's been showing to be the difference. It started here and it revisited there, and it showed you that it is a resistance zone. If this fails, you don't want to be in this stock. Okay. Right now, I have net free position. I see two outside bars. I haven't done anything yet. Okay. What would I do if I get a third outside bar on the macro market? Well, then depending on where the price is on PLTR, I'm probably going to say, look, I bought the thing at 13. I got my money back at 26. I've got what? 26, over $100 per share profit in this thing. So Mooch, do you think I'm willing to let $100 a share profit just go with the wind and just let it go on three outside bars? Not a chance. Okay. What am I willing to do? I'm willing to spend up to $6, $7 of 100, maybe as much as 10%, up to $10. Maybe take two different puts. Okay. Maybe take something like a 120 put that puts me below this structure, and then maybe take something out to September like 100 put that cost a total of $10. I would probably do this one if we broke below this on a 3-bar outside bar. These are already going in the money. I would probably take this, because if this turned out to be a drop in the summer into the macro markets, did something, a big drop and got me into these, I would just be taking these off the table. I incurred no loss on my stock from here down to here, and now I still got protection into here. And then you would just be looking at the market and say, should I just take the profits off of this and just now live with it? Or do I just watch the 200 and maybe take an 80 and all kinds of strategies? But the answer to your question is absolutely no. I will not let my net free holdings just go with a triple outside bar. I am going to go heavy hedge protection across all of my positions. Okay. So just think of I always say, people are like, I don't want to lose money, give money up on my hedge if the stock goes up and I have a put. Well, I'm sorry. That's just stinking thinking. Okay. It's not wise thinking. When you have a technical warning like that, it's not wise thinking. And now I'm just going to call it what it is. It's foolish thinking. Okay. If you've bought in here and you're up $50 or $40 and you're not willing to take $4 of that, 10% of your gains, to protect 100% of your shares? I don't know. I mean, especially when in a period, I'm not saying do this. I'm just saying I've done it before when I'm not net free. And we just did this with ARM. Okay, right? We traded ARM. Something was said that dropped ARM down here, and it's on Twitter. You guys all have it on Twitter. I said buy the stock, and I was in the room and I'd already bought, but it moved. It was like at 116, and they saw me. I just bought it again. I said, guys, I'm telling you, just buy it. Okay, just buy the stock. So if it had all the signatures of a basing bottom, you also had this nice little support zone right here. Okay, resistance becomes support. Okay, would have been an easy out and I'm fine saying I was wrong. Everyone needs to get out of this. Okay, but it moved all the way up. What we did is when it moved up, then we put a put call strategy into place on this stock, where I'm going to take a 150 covered call to give me an extra $15 when we did it. Okay, $10 to $15 of move of the stock, plus we got $10 plus for the covered call. So that means you get $25 a share if you get called out. Okay, these were extra shares that I bought. I've got a large position. It's my largest holding. ARM is. It's net free. So will I do protection on it? Yes, I will. But these were extra shares because I'm like, if they're going to give me free money, I'm going to take the free money. So from that 115, you made what? 25, 35, you make $20 a share. What are you going to do with this? I know that there's resistance up at this level. I've noted it to the team that you got to be watching that 135 zone. Okay. And that 135, sure enough, every day it was like testing it. Okay. Member asked me on this day, should I hold or I personally would take the money. I would take, if you don't want to do a strategy, just sell the shares. Personally, that's what I would do. You're a trader. You can always get back into a stock. You can't recover the money lost if I'm right? So it sold off hard down here into the 50 EMA, which to me was a buy zone again. Okay. You've got down to this major support zone that you need to be aware of right now. You've got a gap sitting here that I don't think got filled. High of 118.82, low of 121.56. So do a little Monday homework. Usually I do these Sunday night, start posting for people. So you've got a gap at 118.82 if the markets are down Monday, or if they are down and then they turn around and this has come into this gap and filled, I would be a buyer of ARM at that level. Okay. And then what you'd watch for is a reclaim of the 50 EMA. And then your meat money is up into this 20 EMA would be your meat money. And that's about a $4 or $5 move back up. Okay. So that's how I would do as a trader, not as a long hold, but as a trader. So I'm covering a lot on here about long hold versus trading, but as a trade, these were extra shares bought here. To me, it was a trade. I took the 150 covered calls. I then bought puts. I bought the 135. I had at the time 130 puts, and I think I had the 115 puts based on these levels back through here. It pushed up, and you got members, correct me if I'm wrong. I was surprised to see this move above 138, and we ended up at 141. It was a surprise move for me. In the overnight, it got up to as high as 141. Well, during the day, it got up to 138.50. NVIDIA was going to report this next day. It got up to 138. Right when we were at 138, I told everyone, I am taking these two off, my 130 put off, my 115 put off. I'm taking both of those off, and basically the same amount of money that those two were at the time. I said, I'm taking a 138 put for earnings. I'm just going to lock in everything down into, if I was wrong and it kept on going, I still got a gap between here and 150 getting called out that's going to negate the cost of that 138 put, right? And still make more money. But if I'm right, or not right, I didn't know what it was going to do. But if it fell, I wanted to be right at 138. So sure enough, it ended up selling down. Okay. You can say, well, that was lucky that you just made that decision. It was based on NVIDIA. We all knew NVIDIA was going to be a big market mover, right? We shouldn't be surprised. This had already made a big squeeze move into above a resistance level. I thought this was a gift. And so I took advantage of the gift and bought a 138 put when it hit 138. It then traded above 141 in the overnight. And in the overnight session, I posted that I'm selling my shares and just taking the risk on because I had covered calls, meaning that I have to supply these things at 150 to someone. If this had shot up to 150, I would have missed all the gain between here and up there. I would have bought somewhere along the way, but I just took a risk on because the futures were above 6,000. And I had said that I think 6,000, we're going to peak above 6,000. But to me, that looks like a trap that's going on in the macro market. It's setting us up here. So I sold the shares. We ended up coming back down here. Unfortunately, even though I had the 138 put, unfortunately, I bought the shares back. If I had just accepted the risk because I was already up and I could have always just bought them back at my buy price, that was a trading mistake. I'm willing to admit it. It was a trading mistake. Should have just left my shares off because then I would have been making money on naked calls and puts all the way down to here. Would have been worth a fortune. Okay. So it was a tactical error that I made on there. So yeah, did I pick up a few dollars? Yeah, I picked up a few extra dollars. I got back under 138, right? So it's not like I was losing money against my put, but it was a tactical error. And that's just the nature sometimes of the market. I should have left that off and this would have been absolutely a 4-bagger plus type of a day. What's the thought process regarding inside bars? Okay, well, let's find one. Here is an inside bar. Okay, there's an inside bar. The way that you do inside bars is you could take risk on above that level, and what you're going to watch for is it needs to break above what's called then the mother bar. So inside bar, mother bar. So the previous day is the mother bar, and a lot of people wait for it to break above the mother bar and then take the position. If you notice, institutions are mean. They're cruel. They're never going to be your friend, ever. Don't ever think they're going to give you anything. Because what did they do? If you waited for the mother bar to get broken, okay, it gapped up. This area of the trade, that's like what, $3-4? You would have had to make a choice. Do I buy here with a stop if I lose back down into here? Or do I just go ahead and take the buy? You would have been rewarded in this instance because it opened here and it just keep pushing up. You would have been rewarded in this sequence. Okay. Doesn't always work that way. Okay. So it doesn't always work that way. In fact, here's one right here. Inside bar, mother bar. If I get below this, that means, okay, you should get some follow through to the downside. Well, it opened down here. Once again, it opened right here at this, where the base of this body of the candle, the green, okay, it opened down here, meaning that where are you going to buy your put now? If you buy a put now, it's already taken this part of the move away from you. From the mother bar down to here, it's gone. It's not like you get to, it broke down through here, I'm going to go ahead and buy put. It didn't give you that. It took it away, opened it here, paid a little bit, probably to suck in some put buyers, and then squeezed them all the way back up, creating an outside bar to the upside. Isn't that cruel? Okay. And then what did they do? They gapped it up right here at the open. Again, you had no ability to buy this stock until here. unless you waited till it got compressed back down close, and then you would have just watched the intraday. It closed down here at the low. Technically, even though this is an upside down day, meaning it's a red candle, but it's a higher high, higher low, and it closed above this outside bar. It closed above it. Technically, that means upside generally, right? And these aren't hard and fast, but as a general rule, if you were going to be a risk trader, you would take calls on this trade with a stop right here. Doesn't mean they're not going to kill you, by the way. And what if it had opened down here then on that? So these are not 100% rules. They're general rules. Would you be willing to take a call trade at the day's close when you see that we're going to close above the mother bar? If you did, you woke up to a gap. It closed here. It gapped up. Again, the institutions are not your friend. They gapped it up here. You would have been trimming at the open, because what happens at the open? You got everyone, all the day traders are piling in, so premiums spike at the open. Something that's maybe really should only be priced at 115 will be at like 160. Okay, you bought it at maybe, let's say you bought it at 40 cents. This opens at like $1.60 to $1.08 and pushes to $1.80, right? A lot of times then if it didn't just keep on going and it stops and just kind of drifts, and then later in the day, and I don't know what happened, this could have paused for 45 minutes, an hour or something, and then gone. What'll happen is the premiums will then subside, and at the same price, something that they were paying $1.80 for, you could only get $1.25 for. So you've got to be mindful of those things when you are in a trade as well. Did that help, Jay, an understanding in terms of it's just really the opposite of an outside bar? Okay, you still got the mother bar to contend with. It's just that when you break above, you could make a decision and say, you know what, we traded down. I see that this opened down here and it drove through the body, which happens to be around the 50 fib. If this goes above the 50 fib, I'm willing to take a trade on this stock, okay? Because that's a failed breakdown, which is important amongst itself. It created an outside bar. To me, outside bar up, my lean is always going to be upside, okay? It's a trap. It's an upside bar. If you had said, what would you trade? I would say I would take the upside on this stock. You would have gotten an open right here. You would have trimmed. It would have pulled down. The premiums would have crushed down. You would have had to make a decision. If you ask me, what are you going to do with your arm? I would say I'm going to hold it unless it comes back down into this mother bar. Okay. If it tests into the base, if it closes above here, I'll stick with it. If it closes inside of it, I'm out. Okay. Or if I have a trailing gain on the stock, I'll say I've got to stop on this and I'm going to get out. It held pretty much and wouldn't have gotten you out. It also, you would have paid attention to the 50 fib, that it held the 50 fib, and then it gave you another return the next day. Okay. James is going to go eat at Jay's bar. Okay. Inside at Jay's bar. I see. Play on words. All right. Anything else? We've gone way over our time. I've got to go do something on the grill. I hope this helped. The triple outside bar in a sideways market. Watch the third one, especially. We don't know what's going to happen. So let's just see. And you just test what I'm telling you right now. Maybe we don't get a third outside bar. Maybe we just break out and that's fine. In that case, pay attention to this outside bar. It happens to be the high of the cycle, 595.54. So you're going to watch that, and if it closes above it, your lean is going to be bullish. If it closes below it, if we trade above it and close above it, your lean is bullish. If you trade above it and it comes back in, to me, it's confusion. I don't know. That would be a failed breakout, which means generally downside. I don't know. Okay, I'd have to come into the next day with my plan. So you first have this one though to help you out, right? You have this outside bar, which is 593.20. These are pretty tight technicals. Okay. So you have two there, and then you have downside on this one. A close below 586.07 has not occurred. 586.07. This is how you want to set up your charts. And then this outside bar had a close below it. Let's negate that. We don't need to look at it anymore. It already led to more downside from the close below, right? Let's negate that. Let's pay attention to this one for now. The upside, however, of this one, let's pay attention to. This can get you there. Okay, that can get you there, but you got to get that first. And then, unfortunately, I don't think you can play from here to here with much confidence. You need to get above that. That's too tight. You're talking about if you're in a trade Monday because you open down here and you come above the 50 fib, I'm taking a trade and it breaks to the upside here, get down to runners because this could be a trap. Okay. Just like they did way back here. Okay. Right here. Okay. You had this resistance. They took it to a new high and then they trapped you. Don't be their fool. Okay. It's what I just constantly trying to get my members not to be, taken in by the institutions. There's so much better, easier trades than trading during sideways markets, by the way. So during those periods of time, what did I tell you? Smaller accounts. I said, just get out and don't do anything. If you do anything, buy one of those cheap puts. But otherwise, just sit on your cash. Because the last thing I want to do is take someone with a 2,000 or a 3,000 account and get them absolutely their head handed to them because they're trying to make trades during this volatility period. Now, trading inside the day, you could go for it. I love volatility. Traders should love volatility. I like volatility better when it's trending volatility, but I just like volatility. Okay. We hate it when we're just sitting here twiddling our thumbs on the market. It's a tight range and not doing anything. Something else you want to do, and I'll end with this. You always want to look at your weekly candles. What do you got? I've got an inside bar weekly candle. Okay. Now we already have the high marked on that. Okay. That's these last two things that have been going on. The outside bar is the high, that one. The outside bar is the high this week. Last week, this week, that high was the outside bar high. Okay. That occurred. So you have an inside bar sitting here on the weekly. What are you going to do on breaking that outside the mother bar on the weekly, right? It tells you something, right? It's telling you something. So you want to pay attention to these outside weeklies, and then I'll even go to the monthly, and I want to see what's going on. Obviously, you can see this huge drop. This was the March, April bottom drop, right? Dropped out of the market. And you want to note where that happened, by the way. Okay. You think that factored into me looking for a bottom? Anybody? Anybody? You think Sunday night when I saw that we were hitting into this and I saw that we were hitting into the 50 fib at that 475 level, anybody think I made note of that? Okay. Telling you, draw from where the markets turn, draw the lines. I see people saying drawing lines is a waste of time. They're idiots. Okay. They're clowns. Don't listen to them. Draw the lines, make a fortune. Okay. All right. That's it. Good luck to everyone Monday. We'll see you then.